this is Richard Campo from Rose Capital Partners. I wanted to put this video together for some of the key things you need to think about if you're buying for the first time. For as long as I've done this job, the two main questions that people think about are how much can I borrow and how much is it going to cost? So dealing with those in order then, so how much can you borrow? There's a very short answer, which is about 4.5 times your income. Some banks go as far as 5.5 times income, so you're sort of somewhere on that bracket. Now the key thing around mortgages and what makes it difficult is what banks constitute income as. So just to pick a really simple example, let's say you earn £100,000 a year. You think, well, I could borrow 450. So that seems very simple. However, if you break it down that your basic salary is £50,000, but your bonus is £50,000, yes, on paper you earn 100,000, but a bank might assess that as much less. So typically banks take around about half of any bonuses or variable income. So on that simple maths again, so you might think you can borrow 450, that actually work out to be about 337,500. That's sort of where you might get to. Again, these are sort of very bland examples. There are exceptions and you can go way above or below that, but this is just giving you a benchmark as to roughly where you should be. If you're self-employed, it's a bit more complicated still. That would be a very long video, but what I do just for simplicity's sake is that if you are self-employed, what banks will look at is either your salary, your dividends, your profit, or a really key thing in your accounts is your profit on all ordinary activities before tax. So some or all of those things will be taken into account and then that multiple applied. It can work out more favourably if you're a limited company director. What some banks do is effectively gross up your dividends. So that actually means that 100,000 might actually be greater and you have a greater borrowing potential. So it's not all bad news when you're self-employed. The second part about how much will it cost? Again, no straight answer unfortunately, because it depends on a number of factors, which is what I would call the structure of the loan. Again, this is broken down into two key segments. So the first part is what we call the repayment vehicle. So do you want to go for a repayment loan, an interest-only loan, or a combination of the two, which is called part and part. So how those work is a repayment loan is very straightforward. You pay monthly payments and at the end of the term the loan is repaid. Interest only means you just pay the interest that sits on top of the account and then you look to pay the loan back through other means further down the line. It could be investments, selling the property, bonuses, that type of thing. So that has a really big impact on how much the monthly payments would be, because interest only is much lower but greater risk, repayment higher, but then obviously you've got no risk of the loan not being repaid. Obviously with a repayment loan as well, what you can do is stretch the term. So you can have, many people start with a 25-year term. There's nothing wrong with going for 35 or 40 years initially. Conversely, if you have a smaller mortgage, you might want to pay it off much faster. So that's probably the key consideration. The second one is then what type of product you go for. Again, these fall into sort of two simple brackets again. So you can either have a fixed or a variable rate. Fixed rate does what it says on the tin. Typically for 2, 3, 5 or 10 years, your mortgage payments are set and you don't have to worry about it. A variable mortgage sometimes is cheaper, and not at the moment, but it is sometimes cheaper. But then that could go up or down depending on what happens with the market. The upside to variable rates is they're often penalty free. So if you've got lots of cash coming in, you may want to move. There are upsides to that as well. So once you put all those variables together, that's what determines your monthly payment. So what we tend to do is work the other way around. Rather than saying how much is it going to cost, we say how much can you afford? And then we'd structure the loan accordingly based on your risk profile. So that's a bit of a whistle-stop tour on sort of the key things to think about if you're buying for the first time and the structure of a mortgage. Hopefully that's been useful, and if you'd like to contact me or any one of the teams to talk this in more detail, please feel free to do so.